My name is Jeremy Capron. I'm the Director of Research here at ROBO Global, and I'm talking to you from New York. And with me on the call are my colleagues from the research team, Nina Deca and Zeno Mercer. And today we're going to talk about robotics, AI, and healthcare technologies with a focus on deals and fundings. So we will be looking at both the public equity side, where we have seen some major shifts in the last 6 months, as well as the private side and venture capital. And we will discuss some of the key trends that we are watching. And we'll also make sure to save some time for your questions. And as many of you know, we regularly share some of our research on the roboglobal.com website and in our bi-weekly emails. And we just published a new report that's covering today's presentation. So feel free to download this report at roboglobal.com. So let me start with a quick reminder of what we do here. We are a research and investment advisory company that's focused on robotics, AI, and healthcare technologies. And we design thematic investment strategies around what we believe to be a technological revolution. And today there's over $3 billion in funds tracking our strategies. They're primarily in ETFs. And the most notable index is probably ROBO. That was the first robotics and automation index portfolio that launched in 2013 and now in its 9th year. And our research around automation led us to realize that something important is happening in 2 specific areas. And so in the last 4 years, we introduced 2 additional index portfolios. The first one is THNQ, or Think, that is the Artificial Intelligence Index. And the second one is HTEC, or HTech, that is the Healthcare Technology and Innovation Index. And these are not your traditional index ETFs or investment strategies. Combine a research-driven approach with the benefits of index investing and the ETF wrapper. And the portfolios are selections of best-in-class companies from around the world, small, mid, large caps that are more or less equal weighted and rebalanced quarterly. So they are diversified with 60 to 85 holdings, yet they have a very high active share and low overlap with broad equity indices like the S&P 500. And the 3 strategies have outperformed global equities since inception, as you can see on this table of index returns as of the end of April 2022, even after the brutal decline in the past few months. So why are we talking about M&A? And fund flows? This is important to us because M&A has been a strong tailwind to Robo's returns since we first designed the portfolio in 2013. In the 8 or 9 years that we've been running it, we've seen 27 takeover attempts on our portfolio companies. And this is in the context of a little more than 80 companies in the index. And we'll get back to that, but the important point here is that we have seen a clear acceleration in the past 2 years, despite the significant business disruptions during the pandemic. And in fact, 2021 was a record year for mergers, for acquisitions and venture funding, as the pandemic really turbocharged the digitization of our economy and left some major scars as we came out to the other side. You think about the supply chain disruptions, you think about rising commodity prices and transportation costs and the shortages in semiconductors and now increasingly pressing labor shortages. So this has led to a race to digitize, to automate, and this has made automation a top priority for business leaders and companies around the world. And especially for those larger organizations that increasingly understand they must have a presence and capabilities around automation. And in many cases, they are behind the curve and they need to acquire rather than build. And they're ready to pay up for quality businesses. Now, this is a very much structural trend in our view, but the massive shifts in the financial markets over the past 6 months have clearly changed the dynamics in terms of capital deployments. And in just 6 months, we have moved from a kind of a Goldilocks of strong economic and profit growth to one of the most complex macro situation in decades. We have war in Europe, we have oil that's up 75% in the past year and well above $100 a barrel. We have signs of a slowing consumption just when the Fed is starting a rate hike cycle. And I think tech is really where the action has been concentrated in the past 6 months. We've seen a dramatic collapse in the most highly valued segments of the markets, the most speculative areas of the market. We've seen essentially the gains of the pandemic being given back, and in some cases some more. And it's not only the Zoom and Peloton and Robinhood. In fact, nearly half of the NASDAQ stocks are down 50% or more today, and from the high. And more than 1 in 5 stocks is down more than 75%. So that is comparable to the dot-com crash in 2000. And the FANG shares are down more than 35% on average year to date. And our 3 strategies are down between 27 and 34% as of the close yesterday. So on the May 17th. Now, that qualifies as the sharpest drawdown we have seen since we started Robo in 2013. And it is on par with the sell-off during the COVID lockdown panic. Now, the good news is that in our view, this valuation reset is largely played out. And I will illustrate this with a few charts in a minute. But before that, on this next slide, I want to highlight that the technology and market leaders in AI, in robotics, in healthcare technologies, the companies in our 3 index portfolios, they tend to be high quality businesses in terms of their margins, in terms of their return on capital, and the strength of their balance sheets. And this chart here shows the percentage of companies with a net cash position for Robo, HTech, and Think, and some of the broad equity indices. So 65% of the companies in the artificial intelligence index and 55% of the companies in the Robo index have more cash than debt, which is a measure of balance sheet strength. And that is a lot more than you'll find in the NASDAQ or the S&P 500 index. And I also want to point out on the next slide that the companies we're talking about here, they are not just US companies. You can see here that we have more than 13 countries represented in Robo, and that a lot of them are small and mid caps. Between 50 and 60% of the Robo and HTech portfolios are in small and mid caps. And the vast majority of them are not represented in the S&P 500 or global equity indices. And so most investors have very limited exposure to the companies at the forefront of robotics, AI, and healthcare technologies. So let's look at what's happening in robotics first. Then I'll pass it on to my colleagues to discuss healthcare technologies and AI. And we will wrap up with what's happening on the venture capital side. So this is a chart of total returns for Robo over the past 5 years, just above 12% compounded average. And you can see the names of the companies that have received a takeover offer over the past 5 years. As I said earlier, in the 8 or 9 years we've been running it, we've seen 27 takeover attempts on our portfolio companies. And this is in the context of around 80 plus companies in the index. And you can see a lot of activity in 2020, in 2021. And since we last spoke to you about 6 months ago, we've seen another 2 transactions this year in robotics index portfolio companies. The first one was Samsara, which agreed to be acquired by Stryker in January for just under $3 billion. And I will let Nina tell you more about it, as Samsara is a healthcare automation company that was also a member of HTech. And then we saw Blue Prism. If we can turn to the next slide, please. You have a list of some of the most important deals we've been watching over the past few months. Blue Prism eventually agreed to a takeover by SS&C, which is a private equity firm, and that came after a short bidding contest with Vista Partners. So Blue Prism went for about $1.6 billion, and Blue Prism is a top 3 player in robotics process automation, which is essentially software robots that automate business processes that you can find on desktop computers and enterprise systems. And in the report that you can find on the website, we also discuss a number of important acquisitions made by robo-index companies like Zebra and its purchase of Matrox Imaging to push into computer vision, and a deal by Active to boost its autonomous driving and connected vehicles capabilities by acquiring Wind River. That's a provider of software solutions for, I think that was around $4 billion. So our view is that despite the more complex macro backdrop that we're facing today, M&A is likely to remain strong in robotics automation. And that's because the recent market sell-off is presenting attractive opportunities, and acquirers have the financial capacity to acquire many of the smaller and mid-cap companies. And that is something that I want to conclude with this historical chart of the price-earnings ratio for Robo. And you can see that the world's leading robotics automation companies are now trading on about 22 times earnings, which is below the historical average of 24 times. And that is also below the pre-COVID levels of 2019. And that is not too far off the 19 times PE of the S&P 500 index. So the premium relative to a broad equity index is relatively low now. And that is despite what we anticipate will be superior earnings growth over the long term. So I will leave you with that and ask Nina to join us and discuss trends in healthcare technologies.
Thanks, Jeremy. Hi, Nina Deca here. Thanks for taking the time today to join us. HTech is, for those of you new to the story, our Healthcare Technology and Innovation Index. This is comprised of 80 or so best-in-class healthcare tech companies that we believe represent the growth and disruption over the next 5 to 10 years that is undoubtedly happening as we speak in the healthcare sector. And as it pertains to recent performance, right now, similar to a lot of the macro themes that Jeremy was discussing, there has been a pullback in healthcare tech. It has not been resistant to a lot of the macro related pressures, such as rising interest rates, concerns about inflation, the increasing cost of debt, obviously, and so that's it's caused a lot of investors to take a pause on some kind of high growth tech forward names, particularly those who might not be profitable or cash flow positive yet. But as you can see in this chart, the ROBO Global Healthcare Technology and Innovation Index, HTech, has tended to outperform the broader markets over the long term. In fact, even in a 3-year period, it still continues to outperform global equities. And then if you look at a 10-year back test, it's still double the performance of global equities. So we are remaining long and strong on healthcare tech for many reasons, and I'll dive a little bit deeper into some of the M&A transactions that have taken place over the last period. So let's see. Jeremy mentioned earlier Vocera, because this happened to be a company in both Robo and HTech. Vocera is a really interesting communications provider with a large presence in healthcare. This is a technology that you may not have noticed, and the reason why is because if it's doing its job correctly, you don't even know it's there. What I mean by that is, I like to give the example. A few years ago, I was in a huge trauma hospital in New York City, Bellevue Hospital. It's a very busy city hospital. And it was very loud. I was in the emergency room. Everybody was shouting. There was noise, alerts everywhere. A few years later, I went into this emergency room and everything was quiet. And I asked one of the nurses there, "What's going on? Why is everyone whispering?" And she said, well, we recently implemented Vocera, and it's really caused a streamlining of all of our operations. We've been able to turn off all the alerts, and they really only trigger when the specific person needs to be alerted when something interesting has happened. And so rather than having alarm fatigue, we've had it all in our households where you just hear beep after beep, alert after alert. That's dangerous in a hospital environment when you get alarm fatigue. So Vocera has a way of re-coordinating this across devices to make sure the right person at the right time gets the communication. When I talked about M&A, well, what happened? Stryker acquired them. Stryker is a world leader in orthopedics, neuro, spine, and this company made a $3 billion acquisition earlier this year to acquire this communication platform. And so this is in line with, to Jeremy's point, how we do expect to continue to see M&A. This is in line with healthcare tech increasingly becoming digitized. Healthcare is one of the last economic sectors to become digitized. I mean, it's only not that long ago that people were still, and maybe still are, filling out paper charts when they go to the doctor office. So there is a huge opportunity for healthcare to continue to be more and more digitized, and that is driving an increasing amount of investment activity. And the Stryker acquisition of Vocera is just one example. Imagine Stryker is everywhere. They're in the ambulance, the entire patient's journey. They're in the emergency room. They're in the operating room. And then upon discharge, Stryker's got stuff that can follow the patient to the home. And so now with Vocera and an integration platform, they can integrate all of those devices and better keep an eye on the patient wherever the patient is. So, so when we think about healthcare and long-term things, we think of decentralization, like an increasing amount of care outside of the walls of the hospital and more where the patient is, whether it's their work office or their home. And so integration, digitization platforms is going to help these devices follow the patient wherever they go. And speaking of digitization and decentralization, and in this theme, we saw another monster acquisition with Masimo during the period. Although this one was quite controversial, when Masimo announced the acquisition of a company called Sound United, they lost about a third of their market cap that day. And the reason why is because the market didn't like the fact that this world-leading patient monitoring company acquired a consumer electronic company. I mean, why does Masimo need to own speakers? Well, what Masimo said they acquired was a global distribution channel. Masimo is launching a watch, not like the Apple Watch with all the apps, but more of a watch with that'll compete with Garmin and Fit. And so what they acquired when they bought Sound United was a global distribution opportunity, an existing footprint of people who already like that company and use their electronics. What the market might be missing though on this acquisition is that Sound United also has a home operating system. This is a multi-room operating speaker system that integrates with all the technology in a household. Masimo is going to integrate all of their high-tech hospital-grade equipment into this multi-room operating system. And what I envision, and the company's not really talking about this, is the opportunity to really bring a hospital at home environment so much so that should something happen to the patient as they move from room to room in their own home, that potentially one of their monitors could trigger an event and they can real time get a nurse or doctor on the phone in through their speaker system and just say, hey, did you fall? Are you okay? I think that's revolutionary. And this is the future of healthcare. So when we think about watch and fitness watches, sure, maybe a $1 to $2 billion market opportunity. When we think about home telehealth device, this could be a $120 billion opportunity. And I went into all this detail here because I just really wanted to highlight how much opportunity there is right now for investment in healthcare technology. And the macro environment, although it is pressuring stocks, it is not slowing down investment among these companies. Outside of digitization, there's a lot happening also in the diagnostics world. I'll just briefly touch base. Quidel announced the acquisition of Ortho Clinical Diagnostics. That's expected to close in the coming weeks. This is huge, $6 billion. Quidel is one of those companies that really showed their market technology leadership during the pandemic. That this was the COVID antigen test company. They really changed the face of what was happening in the pandemic and let people go back to work. But now that the pandemic's becoming endemic, Quidel's stock has pulled back a lot, and so has their COVID testing volume. Pairing up with a company like Ortho is really going to help diversify their product offering and enlarge their footprint. And Ortho is a diagnostic leader, and so we're excited when that acquisition is expected to close for that to be an added asset into the H-Tech portfolio. And then other cool things that we're seeing in the diagnostic space as it pertains to pullback in COVID volume. Companies like Danaher and Thermo Fisher Scientific are market leaders. They're in the H-Tech portfolio. These are also companies where people thought, wow, you guys had a lot of COVID testing, but the market was worried that there was going to be a pullback in revenue when COVID testing pulled back. But these companies are so diversified that they sold a lot of instruments for COVID testing over the last 3 years. And now the labs can use their instruments to run other tests. So while COVID volumes have come back, they've seen an uptick in other tests. People are going to the doctor for other things now. And so we're really happy to see this level of diversification. And that's what you get when you have a portfolio filled with market leaders, such as the ones that are in H-Tech. So I will pause there and turn it over to Zeno, who's going to talk about Think, the AI portfolio. We'll be back around for questions at the end of this.
Thank you, Nina, and hello, everyone. My name is Zeno Mercer, and I'll be discussing the Think Index and Strategy and M&A today. I'm going to nip the bud. I saw a question around performance. So yeah, year-to-date performance as of today is down 34%. So these numbers are to April 30th. This is the worst sell-off for technology in the space since basically .com, and that's kind of discounting what happened in March 2020 because that was a multiple sector drop. Speaking of March 2020, multiple contraction has brought down the portfolio to those levels of valuation. So in March 2020, Think dropped to a 5x Ford EV sales. We're now at 5.22 Ford EV sales, down from 11x at the high in 2021. And we're trading at a 37% discount to the long-term 7.1x EV sales average. Even as earnings and top line majority beat expectations. For example, earnings of companies that have reported so far are up 30% versus the long-term average of 13.7%. So you might be asking, why is Think performing so badly? I mean, some of that is obvious. Global macro conflicts, inflation, just general concern. That is a lot, in my opinion, in our opinion, that's pretty short-sighted. That's why we have long-term views on these trends. But we understand that, people are scared and, that's just how things are. But, that's, looking at 2022, which still sees growth in earnings and profit, top line, as well as, a ramp up in 23 and beyond and things like autonomous vehicles, the metaverse. There's just a lot of long-term plays here that we're excited about. And I'll get on the M&A in a second. I just wanted to talk about this real quick. Out of the 72 Think Index members, 11 are projected to post negative earnings this year. And the majority of those, that's under $1 of negative earnings. And of those 11, 5 are projected to become profitable in the next 2 years. So, just thinking about our portfolio, we have high quality companies that have good cash balance, as discussed earlier, that are in high growth areas. And I think the Think Index has really matured and proven itself in the face of the pandemic. In fact, it's thrived in the pandemic and what's going on in the world. The adoption of the digitization of everything. You've got cybersecurity becoming more and more important as we adopt these technologies across e-commerce, healthcare, fintech. So the thesis around AI permeating into all facets of society and businesses is happening. And despite any temporary setbacks and fears, like these are happening. So I'm going to go into some of those other areas like AV and metaverse in a second when I'm discussing one of the M&A deals. So another, just kind of wrapping up here, Think has exposure to both the picks and shovels, the infrastructure, that's network and security, cloud providers on the infrastructure end, and then on the business side, these are the things that people are excited about. Of what is AI doing? This is the business process, the consumer, the e-commerce, factory automation, and I think having exposure to both provides a great upside potential here, especially as we've seen multiple contraction in the face of positive news mostly. In the past week, we've started to test a rebound in high growth stocks across e-commerce and consumer, maybe signs of being oversold. And we've got about 7% exposure to China. China does have good AI. I mean, we're still majority US and we have companies around the globe, but we've got indications of loosening controls over the technology firms. And we're also seeing delisting fears continue to fade. So a lot of funds got out of that. And so you could see large inflows and positive momentum if that continues to go forward. Moving on to M&A. So next slide. Thank you. So after a record 2021 that saw 8 Think index members, and as a reminder, we have 72 in our ETF right now, or in our index. We have not seen any new takeovers offers so far in 2022. Since its inception in 2018, there have been 11 member takeouts. So 8 in 2021, and the majority of those were private equity funds and consortiums taking tech companies private. They saw value. So since our last M&A report in Q3 last year, we've had 3 takeout offers. So those were all in Q4 2021. And that includes Blue Prism, which has been discussed earlier in this report. The other 2 were Aspen Technology and McAfee. So Aspen Technology, which is a global leader in asset monetization and optimization software for industrial companies, was acquired by Emerson at a 30% premium for $10.7 billion in October 2021. And that was representing a 31x EBITDA multiple. So Emerson is combining Aspen with their own industrial software business and will retain the Aspen brand. So no longer in a portfolio, but that was an interesting deal that makes sense for Emerson. On trend and wrapping up last year's multiple take privates, another thing, member, McAfee, the enterprise security software company that does endpoint detection, network and data protection, was taken private after being public for just 1 year in November by an investor group comprising of Advent, Primera, Crosspoint Capital, and many others for $14 billion enterprise value, representing a 26% premium. Moving on to some of our Think index member acquisitions. Microsoft acquired Activision, which was one of the biggest deals in the history of all deals. In the artificial intelligence universe, gaming and cybersecurity have been 2 of the most active areas of M&A. So what is Microsoft's acquisition of Activision Blizzard mean for Microsoft and the rest of the ecosystem? Well, a lot of this is the focus on the metaverse. You have gaming, which is the obvious story behind Activision. But if you look a little deeper, I mean, the core components of Microsoft are the way we interact and communicate digitally, and that's changing. That's going to be more integrated. I mean, eventually, 10 years from now, 20 years from now, we might not have screens we're looking at. It could be overlaid in AI and augmented reality on our faces, contact lenses or glasses. Microsoft realizes this, and they want the best talent possible. And so a gaming company that knows how to design great user experience, interactive design, and really debug complex interactive environments is great for them as they look to expand into this. And so I actually met and spoke with an SVP at Microsoft several weeks ago at a metaverse conference I was at. And it's interesting, when you think of metaverse, it's a buzzword, first of all, but Second of all, it's real. And if you think about their products like LinkedIn, Windows, Teams, these other things, they're all focused on getting into this immersive environment. And a lot of that is going to require lots of data, lots of cloud infrastructure investment. If you're having a simulation of their virtual world in the real world, and that's all being overlaid, communicating in real time, that's a lot of infrastructure and communication technology. So it's really exciting to see Microsoft and the world heading into this direction. One of the things that requires, though, as we get more overlaid technology integrated into our lives, unlocking our passwords, we're going passwordless. That's a lot of AI to detect if you are who you are, if you have intent to access what you're trying to do, requires cybersecurity. And Think Index member Alphabet recently made the acquisition of Mandiant Cybersecurity for $4.5 billion to join its cloud computing division. So as more assets and services are digitized and automated, cybersecurity is not just a basic need for these companies, but it's a competitive moat, really, to ensure that their customers, whether it's you and I or enterprise customers, are confident and able to continue working with, across increasingly complex environments. So the Think Index captures multiple direct cybersecurity AI angles to exposure to companies such as Rapid7, Cloudflare, Varonis, and Darktrace. And so with that, I will pass it on to Jeremy.
Thank you, Zeno. The last thing we want to touch on today is the private side, venture capital funding. And before I do that, I want to remind everybody you can ask your questions using the Q&A box at the bottom. So on the private side, I think the one-line summary is that we had a record-breaking year in 2021, and the rapid decline in tech valuations in public equity markets has really put a damper on public exits via IPOs and particularly SPACs that have pretty much disappeared. And the funding activity is still strong, and it's happening at somewhat lower valuations. I think it's important to understand that at the extent of the boom in 2021, we saw more than $640 billion invested. That was a record high and almost a doubling year over year. And 2/3 of these funds went to later stage growth companies with very large rounds driven by financial institutions, including hedge funds hunting for pre-IPO companies. And I think that's where a lot of activity of this activity is slowed in so far this year. And in the meantime, we saw early stage funding that was also very strong last year, but maybe not as extreme as late stage. And in terms of where the action happened, it's really fintech companies that raised the most venture investment in 2021, followed by healthcare and e-commerce and transportation. Now, looking at the first quarter of this year, we see that funding is steadily declined by almost 20%, with the shock in the public equity markets. And the number of deals, however, is still up year over year. And we saw strong activity in cybersecurity, in logistics automation, in healthcare technologies. And we expect that over the coming months, the slowdown will continue to affect primarily the later stage pre-IPO companies. And we also see that investor interest remains very strong in the areas of automation, especially solutions that help with the supply chain issues and the labor shortages. And with lower valuations, we see a favorable outlook for early stage investing. Now, finally, here's a short list of some of the recent deals that we are watching closely as they touch on our areas of focus. And these companies will likely come onto your radar as they eventually go public or get acquired. I will highlight a few of them, starting with Samsara on the upper right corner. Samsara is a cloud-based IoT or supply chain software company that raised $800 million in an IPO a few months ago, $12 billion valuation. And Samsara makes cloud-based software solutions for the transportation industry, the logistics industry, the construction industry, and others. And what they do is they help companies collect and manage data, including equipment monitoring, telematics, or how trucks and fleets of vehicles move around, and they do video analytics using AI and some more. And so Samsara went public at a $12 billion valuation, and in just under 6 months, its shares are now trading about 50% below the IPO price. Now, another one is Exotech, and Exotech is a warehouse robotics company that's based in France. They also raised $800 million. I'm sorry, they raised $300 million at a $2 billion valuation. That was the beginning of the year in January. Exotech makes the SkyPod system, that is a warehouse automation system that uses stacked bins and robots that can reach up to 36 feet high. And that's used for very high density storage and retrieval. And that participates in the order fulfillment process. And Exotech is working with some of the world's largest brands in e-commerce, in retail, in grocery. And the last one I want to highlight today is MedAble, which has a software platform for clinical research in healthcare. And they also raised more than $300 million, around $2 billion valuation. And what MedAble does is this easy-to-use software that connects patients and clinical teams and clinical trial sites to enable clinical trials anywhere. And so that's a big change for the industry that should support the boom in clinical trials we're seeing today with the expansion of precision medicine and genomics in particular, and gene-based therapies. So today, MedAble is already working with over 150 decentralized trials. That's remote and on-site trials. And it's the software that enables this to happen. And we think that's going to change dramatically the way clinical trials are conducted going forward. And much of the company's success has been driven in part by the COVID-19 pandemic that drove up demand for remote and hybrid research settings. So with that, I will invite Zeno and Nina to join me, and we're going to take your questions. I see that we have a few in the queue already. And I think we'll start with the question around earnings projections and revisions for the ROBO and also HTech indices. And I think that's a really important point, because that 30% or so decline in the ROBO and HTech index is really all about the multiple, all about valuations. In fact, valuations have contracted by almost 35% from the high. And in the meantime, earnings projections, earnings estimates have barely moved. And we're coming to the end of this Q1 earnings season. And if we look at the 3-month earnings revision, so changes in street estimates over the past 3 months, what we see is that they've really barely moved. So when I look at ROBO first, over the past 3 months, the projected EPS for this year has come down by 1.5%. And of course, it's a combination of the better than expected results that we saw overall in Q1. And that, as you know, that happens most of the time in public equities, where companies, come in and beat estimates, and they try and make sure they don't guide too high. So we've seen a kind of a normal rate of beating estimates. And at the same time, management teams have obviously turned a lot more cautious given the changes in the macro backdrop. So they've tended to reduce their outlook somewhat or maintain it. In some cases, reduce it. But in aggregate for Robo, the EPS estimate has come down by 1.5%. And for HTech, it's 1.8% over the past 3 months. So really not much of a change. And if we look at next year projections, it's the same story. We have a 1.8% reduction in the EPS estimates for next year. So of course, anything could happen, and the noise around the possibility of a recession has increased. Obviously, we have energy prices going through the roof, and historically that has tended to lead to a more of a recessionary environment. But that's at the same time, we have a very strong momentum in the economy today. When you look at the accumulated savings during the past 2 years, and you look at the consumer spending patterns, consumer spending has continued to increase month over month for 4 consecutive months. And the latest data point that came out just a few days ago is showing more of that, with April retail sales up month over month. And similarly, on the industrial side, you look at the industrial production numbers, they're still showing growth, and they're coming in better than expected. So I think, of course, we have to be mindful that we could turn into more of a recessionary environment, but for now, that's not the case. And earnings projections are set in that context. So I want to give the next question to Nina. I see there's a question around the cash flow relative to financing needs in the future. What percentage of companies in the HTech portfolio will need financing to fund growth over the next few years? So Nina, do you want to take this?
Yeah, sure. So we conducted an analysis just to keep track of the cash flow healthiness and the cash situation of the portfolio. And as we mentioned earlier, the majority of the companies in the portfolio are net cash positive. But when we look at free cash flow, there are quite a few that continue to be cash flow negative, because these companies are largely investing in their growth and innovation. But when we drill down further and we look at cash balance compared to the cash burn, what we're finding is only about 5 to 7 of the companies in the portfolio might need financing in the next year or two. And that's out of about 85 names. So in terms of the percent, about on the high end, about 8% could potentially need more financing. And so when we look further of the composition of those particular companies, it's comprised largely of companies like Guardant, Natera, Editas, Fate. And these are companies in our genomics and our precision medicine subsector. So again, companies that are investing heavily into their R&D, their clinical trials on programs that have a very high revenue market potential. To give you an example, Guardant right now is the world is awaiting data that's expected later, potentially in September, October timeframe, on one of the largest ever clinical trials happening in the genomics field. They are evaluating to see whether or not you can draw blood. So the test is known as liquid biopsy. With the blood draw, a routine blood draw that you get at your normal doctor appointment, to screen for colorectal cancer. And the reason why this would be revolutionary is because right now the screening process for colorectal cancer is a little bit more tedious, either through colonoscopy or through stool collection at home that you would mail in. And so to be able to just have, while you're having a routine blood draw, have them tack on a test potentially for colorectal cancer screen, proving that that can work is going to open up a huge market for many, many billions of other dollars of screening for other potential types of cancer. And there are a lot of companies that have invested heavily in this liquid biopsy space over the last couple of years. In the H-Tech portfolio alone, we saw over $15 billion worth of M&A. Illumina acquired Grail. There's just a lot of M&A, people going after this technology, validating its market opportunity. So anyway, I bring up Guardant because they are one of these companies that may potentially need to raise in the next couple of years, but they're working on something revolutionary, and early data is actually showing that this could be quite promising.
Thank you, Nina. And maybe you can remind us the percentage of H-Tech companies that are profitable or cash flow positive, which I believe is the vast majority of what's in the portfolio, and what type of companies tend to be loss-making today with expectations of future profits in terms of what kind of work they do.
Yeah, so about a third of the company has negative earnings, and about a quarter of the company as of calendar year 2022 is cash flow negative. And so again, these are largely comprised of the maybe the small mid cap names in the portfolio, and they're diversified, but largely fall into that genomics and precision medicine subsector. We do have a lot of companies that are more than half the portfolio, about 51% of the portfolio is large cap. These are kind of single digit, high single digit, low double digit growers, very stable companies with positive earnings, companies like Edwards Life Sciences, Boston Scientific, et cetera. So a lot of real stable kind of value oriented names in the portfolio. But it is diversified, and it does contain 49% small mid cap. And of those, like I said, about a quarter are cash flow negative this year. And many of them are on track to cash flow break even. For example, Natera, one of the companies I mentioned, if you look at their cash balance, nearly $1 billion, but a high cash burn rate. However, they continue to have an improving reimbursement environment. They keep getting authorization from the Centers for Medicare and Medicaid that more of their testing is going to be reimbursable. And so what this means is tests that they've already been doing and not generating a lot of revenue on are going to generate more revenue. And a lot of that's going to continue to drop to the bottom line. So, a lot of right things have to happen, but should this company execute on plan, they could actually turn cash flow break even in the next couple of years. Does that answer your question, Jeremy, or did you have something else in mind?
Oh, that's great. Thank you. Moving on, we have a question about how the investment strategies have changed with market conditions in terms of avoiding unprofitable or high PE companies. That's a good question. And I would start by reiterating that we design our strategies for long-term investments, and we don't change our style as along with the market fluctuations. And in fact, we have an embedded mechanism in the index construction process that ensures that every quarter we rebalance. So every 3 months, we end up selling companies that have seen their share price move up the most, and we buy those that have come down the most, as long as, of course, they still qualify for the index, and we essentially think they're great long-term investments. And so you have that smoothing or risk management mechanism that's embedded in our process. But I would say that in general, again, we don't find a lot of unprofitable companies in our thematic index portfolios. When it comes to robo, it's less than 5% of the robo members are loss-making. 95% are profitable, and in many cases, extremely profitable. Those companies tend to score very high on the quality factor. They have fat margins and high return on capital. It's a little different in AI, and Zeno mentioned that we have 11 out of 72 members in the AI portfolio that are loss-making, so it's a little more. And in healthcare technologies, it's even more, just around 30%. But again, robotics automation, it's barely any. And now in terms of the high PEs, that's a good question, and I think you'll find it surprising that in fact we have more companies in robo that are trading on very low multiples than we have companies that are trading on high multiples. And the metric I'll use here is that sales multiple, the EV to sales, where we have about 10 companies or so in robo that have a double-digit EV to sales multiple, so both 10 times, which one could qualify as expensive. But we have more than a dozen that are trading below 1 times EV to sales, and that is remarkable. And those companies tend to be involved in industrial end markets. There's a good number of Japanese factory automation specialists that have a high exposure to China, whereas we've seen a renewed lockdown situation that has severely impacted the supply chains and the industrial end markets. And that's probably why those companies are trading at relatively distressed levels right now, for fear that the situation could deteriorate in the China market. Overall, our view is that the best time to invest in technologies when the valuations are low. And if you have a long enough time horizon, this is a very good recipe. So one more question around the M&A market, and I think Zeno, you could take a shot at that. How do we see the public market derating, impacting the M&A market? Is that a sustained or just a temporary correction?
Yeah, so I mean, there's definitely a correlation with M&A activity and the the re-rating and the public equity market sentiment. Companies are, despite what caused the valuation contraction, companies are evaluating their strategic moves. On the other side, you have companies that have large cash balance sheets that are still able to make acquisitions during this time. They don't, they can make $1 to $10 billion acquisitions for some of these companies, and that wouldn't, impact them that much. Now they might wait, they might be holding off. As we've seen, we've had, zero, like M&A has slowed down in the Think Index, for example, on both ends, both acquiring minus, excluding Activision, Blizzard, and some of the higher ones. I mean, those are long-term strategic plays that are fundamental to the company, right? On the other side, because you might be seeing less stock compensated, buyouts, because they are at depressed stock valuation. So, they'd rather be buying back their stock than selling a company with depressed depressed company shares. So there's actually an impetus that you might see with all the corporate VC that's happened. I mean, corporate VC is at its, it's at its peak. I mean, it could stay and keep growing, but there's so many strategic acquisitions that have been laid out there that you actually might see a lot of cash balance sheet acquisitions for these AI and robotics and other companies due to that strategic implementation. And if there's a company that will drive value for these companies over the long term, and they've made an investment, they'll acquire it. So if we're at zero now, relatively, I mean, the only way we can go is up from here. But I mean, I think that's where we're at. Sentiment kind of improves. Well, these companies aren't not evaluating M&A activity, M&A opportunities. They just with Ukraine and just China supply chain, I think there's just been a couple things that people have been cautious about. But otherwise, I think that's just a core part of business, and there are a lot of acquisitions last year, so a temporary pause just to integrate some of those M&A acquisitions also makes sense. So there's a number of factors there, but I do think it'll ramp up. Small, mid cap, and then large companies with big balance sheets can make moves regardless.
Okay, thank you, Zeno. And I think we've covered it all. So I want to thank everyone for joining us today, and feel free to reach out via our website, roboglobal.com, if you want to ask the research team any question. And you can also sign up for a bi-weekly research newsletter. We very much look forward to speaking to you again soon. Have a great day, everybody. Bye-bye.